Hello there, and welcome to a live episode of Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. Today, we've got an important episode. It's really important to talk to you about a few things. First of all, the good news, and I have a lot of good news today. The S&P has finished at its highest level since we hit the bottom so far that's been established March 23rd. Second of all, I want to talk to you about exchange traded funds for the conservative / stable part of your investment portfolio. Because while we remain focused so heavily on stocks, it's important to realize that there are other things in your investments, in your investment portfolio, that you may well be wise to focus on. So let us roll the introduction. Let us make sure that we are ready to rumble. So here we go. Great to see you. Welcome to a new live episode of Be the Boss of Your Money. If you're watching this from the live stream, thank you for tuning in. I welcome you to ask any questions you may have in the comments. Words of encouragement are always appreciated. And if you're watching this from the replay, I'd like to welcome you as well. Ask your questions as if you were watching this in the live stream, because your questions are important to me, and I will be checking on those questions. So we had a pretty decent day in the market. We were worried. We had a really good day Monday, gave a chunk of it back yesterday. Today, we recovered that chunk, and all of a sudden, people are feeling a little bit more optimistic, in spite of the fact that cases of COVID-19 are rising in the United States. It is more spread out and possibly not the same population that we've seen in terms of age and health issues that we've seen in the past. But more importantly, the market continues to defy gravity. It continues to climb a wall of worry. So we've got a lot of things to talk about. So let's do a quick market wrap, and then we're going to get into the ETFs, exchange traded funds. What are they? How do they work? Why are they important? And what you should know, because this is about personal finance. It's about investing. It's about business. So let's jump to the share screen. This is something that I do every day. If you're new around here, again, I'm Mitch Goldberg. So welcome. So first screen we'll take a look at is the major averages. So we have the Dow up 369, S&P up, decent day across the board, NASDAQ up over 2%. Facebook and Amazon hit new all-time highs. How great is that we actually have stocks hitting new highs? Like, we're actually talking about big companies hitting highs. Such a difference today than just 2 months ago. What a difference a little bit of time can make. We've got a NASDAQ up to 93.75. Folks, we're going to be hitting new highs across the board, it looks like, at this rate. You have the Russell, which is up 3%, the winner of the day. That's the small cap index, and that has been the laggard throughout this entire bounce off the March 23rd lows. So good to see the small caps participating. To me, it looks like a situation where people bailed heavily on the sector. It was under-owned, and now that people see that companies could survive and stimulus measures and PPP, et cetera, that maybe the small cap space is worth a shot. Yes, things will be bad. Things won't be the same. A lot of companies won't survive. But there is such a thing as expectations, and expectations of a worst case scenario have definitely left the station. And then we have the VIX. I've been talking about the VIX a lot. You want to see this consistently under 30. Today, down 8%. That's a good thing. You want the VIX to go down. Under 30 is a good thing. Let's take a look at some of the market movers. MGM Resorts, oil, National Oil Well, a little Twitter. But if you see what's worked out, okay, none of the major companies were really hitting, the big ones. Well, Lockheed Martin's a pretty big company in the industrial space, defense contractor. Kohl's, Nordstrom down. So let's take a look at some of the other movers. I want to look at the Fang stocks. So here you go. Facebook up over 6%, up $13 a share. Apple up almost 2%. Amazon up almost 2%. Netflix off a smidge less than 1%. Google, Alphabet, that is, up 2.5%. Microsoft up 1.39%. I call these fangs the black hole of the stock market. When they go up, they pull everything up. They suck everything into their gravitational force. And when they go down, they suck everything down and they drive everything down. It's really hard to have a big up day or a big down day without these stocks moving in unison, because the market cap on these companies is so big that they literally drive markets today. A lot of people don't like that, and a lot of people think that's kind of dangerous. To me, it is what it is. It is what it is. You don't get to invest in the market you want. You get to invest in the market you have. There's the way it should be, and there's the way it is. I'm more into telling you about the way it is and giving you perspective. Facebook had a big day because it was announced that they're going to be opening up Facebook Shop. So kind of competing there for more for ad dollars, even more aggressively with Amazon and Alphabet, Google search. And also they'll be selling things and they'll have stores and shopping. I wonder how it's going to be for the affiliate marketers. I don't know if you know this, but Amazon recently cut their affiliate commissions to marketers, and people went from earning like 4 or 5% on an item to 1%. It didn't affect all items, but it affected a lot of big items like furniture, things like that, and home goods. But I wonder if Facebook will be able to attract a lot of the YouTubers who are really upset with the Amazon affiliate program. And then we have the sectors of the day. So every day I talk to you about, is it a U-shaped day, a V-shaped day? Today, with energy leading the way, financials right up there, industrials right up there. Okay, these are the spider ETFs: energy, financials, tech, industrials. But when you see energy, financials, and industrials toward the top, that is a very bullish sign. That is a sign that investors are excited about the economy and see good things. Typically, the stock market calls a turn ahead of the actual economic statistics. So the stock market bottomed well before we went into the worst of the coronavirus COVID-19 infection rates in the United States, and the stock market came up well ahead of the numbers improving or not being as bad. There's nothing to improve about those numbers. They're awful, but not as bad, I guess, is one way to put it. So today was definitely a V-shaped day, and that's the kind of day it was. So overall, a bullish day, a happy day if you're in the market. If you're someone who sold everything, 2 months ago, and you're just waiting to get back in because the real drop is coming and the big one, and that special day when everything just plunges and you're just going to put all your money to work, well, you missed it, folks. By the way, those days rarely happen. And when they do happen, what are the odds at that particular moment that you're going to be willing to do it? You see, what happens is when you get that day, markets don't just plunge out of nowhere to give you a nice discount. They plunge because they're reflecting something that people are extremely worried about. And most people who play that all or nothing game, they wait and they wait and they procrastinate and they procrastinate. They don't buy bottoms. That's why market timing is so hard to do. They wait because it's really bad now. They say to themselves, I'll wait till it goes lower. And then the market goes up. And then they say, I could have bought things when they were lower. I'll wait till they go lower. Then the market goes a little lower. And then they say, now it's going lower. I'm going to wait. Then it goes higher. And a month or two goes by. The market's higher. They miss their opportunity. And for what? To time your investments to make a little extra money when you know that long-term is really what pays? I don't get it, folks. I don't like all or nothing trades. But the point is, a lot of people sold earlier and they're just waiting to get back in. Okay. Look, I can understand if you sold a little bit or you were overly aggressive and markets recovered somewhat the last 2 months. It's actually recovered a lot the last 2 months. And you want to take a few chips off the table and be a little bit less aggressive. I'm all for that. Okay. But I don't like the all or nothing trades. So let's talk a little bit about exchange traded funds. I've got some notes here. I'm going to put them up on my screen. You don't need to see these. These are just like for my own tempo and keeping this whole thing going. So let's get into this. For the conservative part of your investment portfolio, there you have a lot of choices. And the reason you have a conservative portion of your portfolio is there's a few reasons why. First of all, they help stabilize your account a little bit. So when your portfolio is going down, the stock market's going down, the economy is tanking, at least you have something in your portfolio that could hold up, maybe even rise a little bit in a generally down market. So that's really important to have, and I don't want you to do without that. So it gives you some stability, and it's part of a diversified approach. Now, diversification is a strategy that we use to mitigate risk, but it doesn't actually keep your account from going down in a generally down market, but it'll at least give you something to hang on to. So if something in your portfolio goes down a lot, stays down, maybe even stays down forever, you have other investments to lean on. Okay. It also gives you an opportunity to have a portion of your portfolio into something conservative for rebalancing. So you could be 90% stock, 10% stability, like cash and bonds. You could be 50-50. You could be the total opposite, 90% bonds and cash and only 10% stocks. But the point is you also have an opportunity to rebalance. So if stocks go up more in a greater proportion than you are planned for your portfolio, you could shave that back down a little bit and take that extra money and put it into something stable like short-term bond funds or ETFs, and protect some of that money, and then build that portion of your portfolio, the stable part, back up. And then when stocks go down to a lower proportion of what you wanted for your portfolio, you could rebalance, sell some of your stable investments, and reinvest that into your stock investments and bring those back up. So rebalancing is important. The other thing is this: as we get older, we have a greater need for stable assets, income producing assets, and cash in our portfolios, and they become a greater proportion of our portfolios as we get older. Because as you get older, closer to your financial obligations, you're going to need money to pay for those financial obligations. And you can't have all that money, or you could do whatever you want, but I don't think it would be prudent to have all of your money earmarked for financial obligations in the stock market, because if the market goes down, then you have to sell even more shares of your investments when they're down. You don't want to be stuck in that position and get into this whole thing called negative sequence of returns and all that. The point is, as we get closer to needing your money, we need to start moving some of that money into something more stable. Now, there's different kind of asset classes for diversification. So some of these asset classes are stocks, which we talk about a lot here on Be the Boss of Your Money. Some of them are bonds, which we talk about not as much as stocks, but stocks just have that rush. They have that volatility that people talk about. People don't talk about bonds because they generally, they're very slow going compared to what stocks are. Oh my, my bond fund went up 3 cents. That doesn't get people excited. But your stock portfolio went up 8%, in a week or something, some big return. That or went down 15%. That's really what really piques people's interest and gets people excited or nervous. And then there are different asset classes. So we talked about bonds, stocks. There's international. There's all kinds of ways to diversify. And then, there are vehicles to help us with this. One very popular one is exchange traded funds. There are also mutual funds, but for today's purposes, I'm going to focus on exchange traded funds. That is also just for me, my own preference of what I like to use. Mutual funds, exchange traded funds, these are just tools. That's all they are. They're tools. My preferred tools for my clients are exchange traded funds, and I think they've got a few advantages. I think they're easier to to trade. You can buy and sell them during the day. You don't just have to wait till the 4 o'clock close. You can use limit orders to buy and sell them. Let's say you buy an ETF that's $50 a share, and you don't want to put all your money into it at once. So maybe you'll put a limit order to buy a little bit more at $45 a share and $40 a share. It may not hit there, so there's always a risk that you don't get, you don't get filled on your limit orders, but you at least have some more flexibility. ETFs are typically low expense ratios because they often just mimic an index, and they're also in many cases more tax efficient for taxable accounts. Okay, by the way, if you have any questions about taxes, speak with your tax advisor, because I am not qualified to give you tax advice. Okay, so this is not tax advice. I can talk to you about capital gains and short-term gains and losses, things like that. But for tax advice, you go to your tax advisor. Okay, so what is well, another thing about ETFs is since they cover indexes, most of the time you'll be somewhat familiar with the concept. So if somebody says, hey, here is an S&P 500 ETF, you more or less that the S&P 500 is the dominant main stock market index that we follow as investors. Now, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index like an S&P 500 ETF. And there are ETFs for virtually everything today. ETFs for small cap stocks, international stocks, mid cap stocks, for natural resources, for just to track the stock markets of different countries. So you could literally find an ETF for anything, for clean energy, for artificial intelligence, for nuclear. It's you name the topic, and there's an ETF for it. Okay, and what is an ETF? An ETF, even though it's 3 words, exchange traded fund, there's 2 parts. There's the exchange traded part, where ETFs trade on an exchange. Imagine like a mutual fund, but it trades on the exchanges like the NASDAQ or the New York Stock Exchange. And it's a fund because it's a package of securities which are put together either based on the fund manager's preferences and the fund's objectives, or just to mimic an index. Okay, so you take exchange traded fund, and that gives you basically how they work. So for now, to get into ETFs for the stable, more conservative, or very stable and conservative part of your portfolio, just want to say a couple of things. Okay, I have my notes all over, and I want to make sure I choose my words carefully. These ETFs that I'm talking about are not meant for emergency savings, and they're not meant for short-term financial obligations. These could fluctuate in price. They are not substitutes for cash equivalents like cash, money market, savings accounts, and short-term CDs. They are actually investments, okay? And since they're investments, they should be considered in that light. So they come with their own set of risks and rewards. So the main risk to these short-term bond funds, and I'm going to be talking to you about these types of ETFs. I'm going to give you 3 examples of very popular ETFs. The main risk is rising interest rates. So interest rates have been going down, and especially recently, Chairman Powell of the Federal Reserve and the Federal Reserve, the FOMC, the Federal Reserve Open Market Committee, they just cut rates to 0% on the federal funds rate. That's the rate that banks charge each other to lend each other money. So interest rates, though, are very low. So if interest rates go up, that means that these these types of bond funds, even short-term and ultra short-term bond funds, could lose money. So you should be aware of that. As unlikely as we think it is now for interest rates to go up, you never know. Things could change drastically. We have a perfect example of that, right, with COVID-19, coronavirus. So you never know. So if you are someone who cannot handle losing any money at all, and you need to keep your account completely flat, except for earning a little bit of interest, then these are not for you. Okay, because you could lose money in them, even if it could be a relatively small amount, but you never know. These ETFs that I'm going to be talking to you about have trading ranges. They could trade between, let's say, $48 and $50 a share. Now that might not sound like a lot, but if you bought it at 50 and now you have to sell it and it's 48, you might be upset and you might say, well, now I need money from somewhere else to pay for financial obligation. That's why I'm saying to you, if you can't handle any loss at all, these are investments. Okay. Short-term bond ETFs, the kind of ETFs we're talking about, which are for the stable/conservative portion of your portfolio. If you can't lose anything, you can't even be in these. And it's just too bad. You'll have to put up with, either zero rates or, 0.05, whatever you're getting from a money market or from the bank. Okay. So, I won't tell you to invest in the ETFs or not that I'm going to mention, because I don't like to make specific recommendations in a live stream or in a video. But if you do have questions specifically of what is appropriate for you and what's in your best interest, you certainly are welcome to reach out to me. You can call me, you can direct message me, email me, what have you. Okay. So let's take a look at the first one that I want to talk to you about. Okay. The first one, and something, I'm using a black background, so you really can't even see the letters. So I'm just going to get out of that. The first one, the symbol is SHV, like shove. This is from a company called Ishares. It's the Ishares short Treasury Bond ETF. And as the name suggests, it invests in Treasury securities. Those are the securities issued by the U.S. government that mature in less than a year. So outside of cash equivalents, short-term treasuries are about as safe as you get. Very little fluctuation with, halfway decent yield. The objective for this one is to track the investment results of an index composed of U.S. Treasury bonds with remaining maturities of 1 year or less. It has an expense ratio of 0.15%, so it's pretty low. It's up slightly on the year, at 0.33% in the year. It's got a current dividend yield of 1.89%. And its low is between, is $110.03 to $112.99. So even something like that, it does have a slight fluctuation. Not a lot. So it is pretty stable. And you can see when the market tanked, this actually held up pretty good. And that's something you would expect from an, ultra short-term Treasury bond fund. So that's a very popular one. And as and the risk in this, it's even as stable and safe as it's been, there's a risk to this. So the Federal Reserve has cut interest rates. So new Treasury bonds that are being offered now are coming in at lower yields than a lot of what's currently in this particular exchange traded fund. Okay, this exchange traded funds, it trades on an exchange, so you can buy it and sell it like a stock. However, so the risk is that as the older bonds mature and sort of, roll off the portfolio of this ETF, they will be replaced by the newer Treasury securities, short-term Treasury securities coming out, which will have lower yields. So the yield on it will probably not. I expect the yield to gradually trend maybe a little bit lower than where it is. That's just an expectation. Okay. The next one is the ICSH. That's the iShares Ultra Short-Term Bond Fund. It's short-term bond funds of corporations and U.S. government funds, bonds rather. And its objective is to It seeks to provide current income consistent with preservation of capital. It's got an expense ratio of 0.08%. So these are all low rate expense ratios. I mean, if you think about it, they kind of have to be low, because if they're high, then they eat up the entire yield because interest rates are so low. And current dividend yield is about 2.33%, and it's got a fluctuation from the high to the low, $50.60 to $47.86. $2.91. So it'll fluctuate a little bit. It'll fluctuate a little bit more than the first bond ETF I told you about, because the other one is short-term treasuries. This one has some corporate bonds, which could fluctuate a little bit more. Treasuries are considered the safest bet in the bond world over corporates. Okay. By the way, I know that there are a couple of questions and comments out there, so I'm going to be getting to your questions and giving you some answers and all that in just a moment. The next one I want to talk to you about, this is a really, I would say this is the most popular short-term bond ETF. It's BSV. B like Betty, Sam, Victor. It's the Vanguard short-term bond fund. So I've gone through two Ishares, two from Ishares, and now I'm going through one more with Vanguard. Just typically, I'm very plain vanilla when it comes to exchange traded funds, and I find that the for my own uses with my clients, I find that I get what I need from iShares and Vanguard. Believe it or not, Vanguard does a lot of marketing to financial advisors like myself. I mean, they're definitely a direct to consumer company, but they're also business to business. So I get marketing emails and mail all the time from Vanguard in terms of how I could use their products for my clients. So, but it makes no difference to me. I use what is in the best interest of the client because I am a fiduciary. So it makes a difference. I want the client to do as well as possible. And whoever I think has the appropriate product for the client, that's what I bring to the client because that's my service. Okay. So BSV, the Vanguard short-term bond ETF, this has an expense ratio of 0.05. It invests in a blend of short-term U.S. government bonds and corporate bonds. It's objective. It seeks to track the performance of the Bloomberg Barclays U.S. 1 to 5 year government/credit float adjust index, a market weighted bond index that covers investment grade bonds with a dollar weighted average maturity of 1 to 5 years. It's a short term bond fund. Okay, that's what that means. Current dividend yield of a little over 2%. It's 2.17%. The high and the low is pretty wide on this. It's between 83 at the high and 78. It's almost a $5 swing. But you notice it's a bigger swing than the other two, the previous ETFs I just spoke about, because it has longer term maturity bonds. So the longer a bond is to maturing, the more time a bond has to mature, the more it'll fluctuate. So so there's definitely a little bit more fluctuation, and that's why I say these bond funds are not for people who are strictly looking for preservation as their only and primary objective. If you're looking for preservation and income, a mix, that's what these particular funds are for, these ETFs. So, for example, for a lot of clients who have cash obligations, if a client's cash obligation is so big and it represents such a big portion of a client's portfolio that I'm managing, generally what I'll do is I'll just take out that cash and put it into just a regular account, because my clients are fee-based. They pay me via fee. So my clients are fee-based accounts. And if you have a $500,000 portfolio and you've got $200,000 sitting in cash, not because we sold something and we're looking to buy something and the money's going to be used, but if that's just going to be earmarked and that money is going to be exiting the client's portfolio, and there's no chance that money will be reinvested, that $200,000 wouldn't even remain in the client's account. It would be better off in a bank account where I pay a fee on money that you're earning nothing on, unless it's there as part of a short-term change in an account or something like that. Okay. So all of these particular ETFs have benefited from lower rates for current shareholders. They all basically have the same risk, though. If rates go up, then it makes the existing bonds in these ETFs worth a little bit less money, and therefore that drags down the overall price of the package of the bond, the short-term bond ETF. So these are some of the really popular ones, some of the ones I'm looking at. This is obviously it's a tiny little itty bitty sample from a sea of choices. But if you're looking for a choice that is more to your liking, you've got some resources out there, you're certainly welcome to give me a shout. Now, let's see who is out there. Okay. Hey, John. John Tutt is out there. Thank you, buddy. We've got a couple of comments. So let's put some of these up here. Okay. We've got Brian out here. What are your thoughts about buying stocks that are in the $1 trillion market, the $1 trillion plus market cap club? Well, that is a little out of the short-term bond ETF talk a little bit right there. Right, Brian? But no, I'm kidding. It's a good question. I don't look at companies as if there's a limit to how big they could get. It's $1 trillion. They'll never be bigger than that. I mean, I remember in the year 2000 when like Cisco and Microsoft were passing $500 billion for the first time. And, they hit one of them, I think it was Microsoft or Cisco hit 600 billion. And then we had the tech wreck. And for a long time, people said that's probably like the natural limit on how big a company could get. Kind of like, I think his name is Roger Bannister, the first man to ever break the 4-minute mile. And it was just considered it was breaking a 4-minute mile was considered beyond the natural ability of a human being. And now many people have broken the 4-minute mile. So I don't know if $1 trillion means something. I mean, if you take a look at Alphabet, which owns Google, the search engine, and then it owns YouTube, and then all the other businesses they have. And then you take a look at like a Facebook, which has the advertising for Facebook. They have Instagram, and you look at all the businesses that Amazon is in. I mean, these companies own other companies that if they were spun out on their own, they would still be in the top 10 biggest market cap companies in the S&P 500. So I don't have a problem with it. There's other things to judge these companies on besides just the market cap. But good question. Hope that helps. Hey, Tom, good to see you. Do ETFs mostly have S&P? I think what you're asking is, do most ETFs track the S&P 500 or other S&P indexes? Because the S&P doesn't just have the S&P 500. They have a ton of different indexes. There are so many indexes today. It's not just S&P. There's the Russell, there's the MSCI. They're the Ishares have their own indexes. Charles Schwab company has created their own benchmarks and indexes. They save money that way. Like if you come out, for example, with an ETF that says this is going to track the S&P 500, you have to pay to use that index, the S&P 500. But let's say, Tom, you and I open up our own exchange traded fund, and we're going to say we're just going to do the Tom and Mitch 500 best companies. We'll make our own index. We get to, it raises our profitability a little bit. That's kind of inside money management baseball there, but no, S&P covers lots of things besides the S&P 500, and there are many other ways to track different indexes, and there's always a new index coming out. There are like probably as many indexes as there are ETFs today. Hey, Frank, good to see you. Good info as always. Mitchell Goldberg, thank you, man. I said this in front of my daughter, and it was really cringy, but Mitch, awesome sauce, baby. Okay, so with that, and then we have thank you very much, Frank. We have Russell Bryant. Russell, you're always around here, and I appreciate that. Thank you. 15 Mitchell for me. 15 basis points on a Treasury ETF. I would have thought it would be lower. Vanguard S&P 500 is 3 basis points. Strange. You're right. When I saw that it's 15 basis points for a Treasury fund, when like you get the Vanguard one for 0.05%. I mean, it's you're talking about a few dollars per $100,000. But yeah, look, there are actually there was a big to do about it. There was actually an ETF that came out that actually pays investors to a tiny bit amount of money to own that particular ETF. But yeah, that is definitely a little high. And if they can't raise a lot of money, or if the ETF starts to lose assets, they'll probably have to lower it to remain competitive. But absolutely for a Treasury bond, for a Treasury ETF, and just think about how if the Treasury yields go lower, then what are they going to do? I mean, eventually, the fee is going to be the entire yield. All right, and Brian is out here. Brian, okay, you mentioned fangs in the beginning of the show. That absolutely, Brian. I did mention it, and I do my market wrap as the first part of this show every day, and I always talk about the fangs. So yes, absolutely, buddy, absolutely legitimate, totally legit, man, totally legit question. So it's important to follow them because just they are such a big portion of the market. And Howie is out there. Hey, great vodcast. Very informed. You know what? First of all, Howie, thank you for calling it a vodcast because that's what it is. It's like it's a podcast, but with video. So the new term is vodcast. So this is a vodcast. So I'm supposed to see the comments right now on LinkedIn on the stream, and they're not showing up. This is a brand new thing. This was just discovered. So I'll see if anybody is out there in LinkedIn land. And there is a comment out there from Howie. Great vodcast, very informative. You know, Howie, I wonder if that's the oh, it is from LinkedIn. Yes, your comment is from LinkedIn. I see that. Thank you very much, Howie. Yes, that is from LinkedIn. You see the little in there. So it is working out. So I don't have to check my my iPhone anymore to see if anybody's out there in LinkedIn land. So it doesn't show me if anybody liked it or not in there. So I guess I'll have to check those out. So that's about it, guys. I hope this video helps you out with your understanding of the more stable conservative portion of one's investment portfolio. And I hope that the options I spoke about definitely gave you something to think about and some education. I'm going to end this broadcast now, and I will speak to you soon. I'll be back tomorrow. Thank you.